Nilesh, I want to get in your take as well. And much on expected lines, the Reserve Bank has kept the repo rate unchanged at about 6.5%. How is your outlook in terms of the kind of linkage that we're seeing with the overall market? Because while the mid-cap index may have somewhat recovered, we're pretty much status quo. Of course, not very market moving, but do you think that with the lingering, worries about food inflation persisting down the line, that could be a bit of a worry for the market, but otherwise it's pretty hunky-dory?
So the 90th year celebration of RBI had three words attached to it: stability, trust, and growth. This monetary policy is reconfirming that RBI's policy will create stability in financial market, trust in financial market, and growth for Indian economy. The equity markets today will be less bothered about food inflation. It's more dependent upon nature's movement. And with monsoon likely to be normal, hopefully food inflation will remain under control. And which is where, if we see RBI's own estimate of FY25 inflation is at 4.5% lower than FY24. I think for equity market, the biggest worry will be complacency. We are trading at a valuation which optimistically discounts many events: election, Fed pivot, earnings growth. All are discounted in a very positive manner. This should not create complacency. Other than that, as you mentioned, markets are in reasonable shape.
Okay, markets are in reasonable shape, but factoring in a lot of optimism already. But just to delve deeper into that, Nilesh, what about the banking sector as a whole? It was fairly muted of late, but the kind of support that you're getting from the RPI and the other decisions and the fact that there's perhaps going to be a rate cut at some point of time during the year, what do you make of the private banking space right now? And in terms of the cut expectations for the rates, what exactly should those be?
So my feeling is that RBI is unlikely to hurry in rate cuts like US Fed. Unlike US Fed, which needs data to cut rate, RBI has ability to wait because our growth is well above our probably expectations. From the banking point of view, clearly right now, deposits remains very important. In banks which have deposit franchise, which has access to low-cost deposits, they are likely to do well. Today, fortunately, on the asset side, almost all banks, be it private, be it foreign, be it small, be it big, be it public sector, they are looking similar. Their NPAs are fully provided for. Those NPAs are transparently declared. So there is no differentiation on the asset side. Even the growth is converging. The most important thing will be deposit franchisee. Right now, liquidity remains tight. In the month of March, RBI's intervention has relaxed it a little bit, but still liquidity remains tight. And undoubtedly, banks which will have better deposit franchisee and access to low-cost deposit, markets will perceive them favorably.
If you like this video, then like, share and subscribe to ET Now.